Welcome to the YieldMax War. Today, we settle the fight once and for all. Do high-yield funds work? The funds in focus, YieldMax ETFs. In one corner, we have Unconventional Wealth Ideas.
Because YieldMax helps us earn over $900,000 per year in dividends, and we're living the FIRE lifestyle here, which means financially independent, retire early.
He's not only buying into these high-yield ETFs, he's doubling down with margin, going all in for cash flow. And in the other corner, we have Kamikaze Cash. He's calling funds like these a ticking time bomb.
If I happen to see one more dividend influencer pitching another 50, 80, even 100% passive income opportunity with covered call ETFs, I'm going to lose my mind. Funds like PLTY, HOOY, MISTY, and ULTI from YieldMax are exploding in popularity because they look great on social media, but it's snake oil.
A trap for investors chasing high yield. Two strategies, two mindsets. One big question. Are YieldMax ETFs the future of income investing or a financial disaster waiting to happen? Let's find out. To understand this conversation, we first need to understand what these funds are doing. These funds aren't just your normal dividend fund. They instead sell options, and it's very important to understand how this process works. These funds sell call options. Call options are a ticket you can buy on a stock which profits as the stock climbs. However, for an option to be valuable, the stock must be above a threshold price. Otherwise, the option is worthless. While people normally buy options, these funds sell options. In the case of our call option, where we profit if the stock price is above a threshold price, the seller of the call option profits when the stock does not increase above the threshold price. Now that we have a basic understanding of options, let's go into Unconventional Wealth Ideas case.
YieldMax helps us earn over $900,000 per year in dividends, and we're living the FIRE lifestyle here, which means financially independent, retire early. And we had another critic come out this weekend, and
I think anyone would be impressed with getting $900,000 in dividends a year on a $1.8 million portfolio. Unconventional Wealth Ideas has found a way to live financially free utilizing high-yield dividend-paying funds. He's not just using high-yield dividend funds, though. He's doubling down with margin.
these dividends are so large, they help you pay down your margin debt, which, as you can see at my channel, is around $600,000. And all of the greats that I know have used debt to get ahead. So we have to use debt to live free from 9 to 5. There's no other way to do it, in my opinion, okay? And so I just have to use debt properly. I always, advocate using margin safely. You don't trade stocks on margin. You get dividends that pay back your debt.
That means he's borrowing money and utilizing that to buy more of these funds. That exposes him to more downside, but also higher returns. His philosophy is simple. Don't wait 30 years, retire now. Cash flow is king. This sounds alluring, and I can understand why. In fact, just watching his videos, I'm now being bombarded by ads for retiring early. People are showing their side hustles and their guaranteed hacks to be able to retire early. Unconventional Wealth Ideas doesn't just invest in YieldMax funds, though. He also invests in his cornerstone funds, which have low margin requirements and allow him to be able to increase his leverage.
The holdings underneath are falling. I mean, very simple. But still, I wouldn't put my whole account into those, and that's where I agree with Kamikaze. I put a good percentage into ULTI and MISTY, of course, but we have to keep in mind that we're running margin here. And even if we're not running margin, we're living free from 9 to 5, which means we need our equity to be preserved. So if we're preserving our equity, we need low maintenance names. That's why I park so much of my money in Cornerstone. And Cornerstone's 30% maintenance. All right, that's how we're able to invest, get extra dividends on margin without the risk, withdraw out of our account without the risk because we keep our equity high because of the low maintenance.
It's the combination of his total portfolio, which he claims has led him to be able to live financially free. He has leveled up his portfolio utilizing margin and loans.
We made so much money this time around again. I've leveled up my account from 15,000 to $1 million.
Unconventional Wealth Ideas returns and philosophy are impressive, but don't count Kamikaze Cash out just yet. He's about to deliver a counterblow.
And the one that everyone wants to ignore is that they will always underperform their underlying stock over any appreciable time period, even after you include the dividends. These instruments sell at the money covered calls with 30 days to expiration. They leave very little room to the upside to grow their share value if the underlying stock rises. So if Palantir is trading for $150 and PLTY is selling a covered call at the $150 strike to collect the maximum amount of premium, Palantir may go up to $180. PLTY shareholders are not participating in that rise, and instead they only get the premium that the fund collected 30 days prior. To get out of that...
This is where I agree with Kamikaze Cash and where I find fault with Unconventional Wealth Ideas strategy. When you invest in a YieldMax fund, the YieldMax fund essentially invests in the underlying stock. We explained earlier that YieldMax funds sell covered calls on stocks, and that is how they pay their distributions. The YieldMax fund PLTY is holding Palantir just like you would be holding Palantir if you bought the stock. Because the YieldMax fund sells call options, they are able to distribute high yields. When the stock goes up, you cannot benefit any more than the threshold price that you sold your call option at. You have capped your upside. This doesn't matter when the market is stable or it's going up. However, if the market were to crash, then you can't rebound. Your upside becomes capped. This is one of the major issues I have with these funds. Kamikaze Cash illustrates this perfectly with Tesla. TSLY is the YieldMax fund based on Tesla.
TSLY first came about at the end of 2022. The ETF was paying about $2 a month in distribution. Now here we are in August 2025, and the last dividend was 30 cents. That's 15% of what it used to pay, about 1/7. You're now getting in about 7 months what you used to get each month. In fact, the dividend will probably drop more over the next 7 months, so it'll take even more time than that to collect what you used to get monthly. If you add up all the dividends that TSLY has paid since that time, you get $34.26 for a total gain of $1.78. A stock that rose 90.5% has you up 4.4% pre-tax. A 4.4% pre-tax return over almost 3 years underperforms a high-yield savings account.
When Tesla crashed in price, the YieldMax fund did too. However, when Tesla recovered, the YieldMax fund did not because it sells call options which limit its upside. Even in the real-world examples being shown, people are losing money, or they're making significantly less money than they would if they had just held the underlying stock.
A little bit more. He's showing you his MISTY distributions. He's had 15,000 shares since March, and although we don't know his basis, we know that MISTY was trading for about $25 on May 1st. So 15,000 shares was worth $375,000. It's a pretty sizable position. Now on August 20th, 15,000 shares of MISTY is worth $255,000. So he lost $120,000 of share value during this window. Conveniently, Richie flexes exactly how much dividend he received from MISTY since May, which is $93,935. So these screenshots of massive dividends come at the cost of about $26,000 in losses, and he still has to pay tax on the distributions. Now, no shade to Richie, this table looks great. It looks awesome to pull $20,000 a month in dividends. But even after accounting for all those dividends, he still lost $26,000.
And here, I think Kamikaze almost delivers the finishing blow. When you put the two holdings side by side, holding the underlying stock never falls below the value of holding the YieldMax fund.
Let's compare Palantir to PLTY, including all dividends paid. Here's the chart since PLTY's inception in October 2024. The y-axis shows the Palantir price, while the PLTY line scales with percentage change, with dividends included. Yes, if you bought PLTY, you made money. Putting your money into Palantir covered calls in October 2024 was a winning strategy. But look how badly you've underperformed Palantir. You're about 30% behind the underlying stock. And don't make
You could literally sell portions of the underlying stock and still have a higher total return than holding the YieldMax fund. I don't think people are understanding just how much money they are losing by going after dividends. Here's where I currently stand. YieldMax looks flashy. Those big payouts feel good. But when you stack it up against holding the underlying stock, you're leaving life-changing returns on the table. The math doesn't lie. MSTY gave you 118% returns, while holding MSTR gave you 187% returns. That's a 60% delta. That's the difference between comfortable and rich. But here's the twist. Unconventional Wealth Ideas is showing us his $1.8 million portfolio, proving that somehow in practice, this strategy is working for him. Kamikaze Cash, on the other hand, is just showing us the academic math, proving why it shouldn't. I'm looking forward for the upcoming debate between these two. What do you think? Is YieldMax a psychological crutch with a shiny dividend wrapper? Or is it a real-world wealth hack the textbooks can't explain?